Well, good morning. We are so glad that you're here. What a turnout for our 100th birthday. I've talked a lot about regulation and demographics, the driving forces that are shaping markets, but also how technology and the rise of that consumer is shaping how companies have to do business, and how these are the forces that are creating disruption. But you know what? Disruption isn't coming. Disruption is here. But in the midst of disruption, there is still a need to grow. But what's the best strategy? Should you go direct to the consumer? Should you enter the voluntary market? Should you expand distribution? Or even think about insuring new risks? But organic growth is really hard in this kind of environment. Today, I want to focus on something, the demographic conundrum that I'm going to call the age dichotomy, and how it should enter your thinking about how to grow. Millennials and boomers, because of their numbers, they are where the action is. Yet their needs, their concerns, and how they buy are so different, forcing companies to bifurcate and segment their strategies. But other industries are facing this too. Now, when I was growing up, having a car represented freedom. Today, fewer millennials are buying cars. They're all about the sharing economy, and they're looking for alternatives. They use car-sharing services like Uber and Lyft. That's why GM invested $500 million in Lyft. And Ford partnered with Getaround to launch car-sharing programs. Think about the implications, though, on the economy of selling fewer cars, or certainly on selling auto insurance. And while millennials seem okay letting someone else drive, aging retirees may not be, even when they should. My mother-in-law. Self-driving cars could help boomers stay mobile longer. I'll pay for that comment. So auto companies and others like Google are investing in driverless cars. But the entire auto industry is being pulled in two different directions. So what's the impact on our industry? Let's start with the millennials. They're about a quarter of the population in the US and worldwide. They are the future of our industry. So it really is important that we understand their expectations and their preferences. Now, you may have seen urgent care facilities popping up in your area. It's in part because of the changes in our healthcare landscape, but it's also about millennials. 6 in 10 would prefer to get their health care from a retail or urgent care facility. As a result, the number of health clinics has skyrocketed 500% in 10 years. For them, it's about convenience and value. Now, the good news for us is millennials are getting older, and they are taking on responsibilities like home ownership, raising families, and they really are interested in protection products. Our new ownership study found that 70% of millennial households own some life insurance. That's 10 points higher than in 2010, and their ownership of individual life has increased 48%. Yet normally they only want to buy what they'll actually use. And like cars, they really only want to pay for it when they need it. Unfortunately, our business doesn't work that way. But marketing cash value, that component, can be very important and attractive to them because they get something back. And our studies show that millennials are also interested in combo products. Why? because the benefit from the cash value comes to them whether they need long-term care or not. But of course, we need to effectively engage them where they are, through social media and mobile, because that's where they're looking for information. You know, they're always on their phones, but think about how they're being bombarded with ads and information. Some believe as many as 10,000 times a day. How do you break through that noise? Remember, they are value conscious. 3/4 of them are more likely to purchase using a loyalty or discount program. How many of us offer those? But even how to communicate with them is changing. You might think you're current because you've built a strong social media strategy, but you may need to change your thinking yet again. In 2015, more people were using messaging than social media. The pace of change, it's constant. I get appointment reminders from my doctor through text. Are you helping advisors do this? Banks are using text to confirm deposits, hotels to confirm reservations, and even municipalities to let people know about storms and emergencies. Could you be doing promotions to existing clients using messaging? Or even sending them updates on underwriting or claim results? 98% of texts are read, and 90% within 3 minutes. Compare this to the open rate for emails at about 20%. How else can we better engage millennials? What if someone designed a program to reward policyholders who acted as brand ambassadors and referred their friends and their families? A lot of millennials might be interested. And we know referrals work. That's why we've been telling producers to do that for decades. The same techniques can work, but we have to adapt them to the new technology. Now, everyone assumes millennials are only interested in interacting online, but that's just not what the research says. Millennials are more likely to use real estate agents than the prior generations. And the same is true with travel agents. They may do a lot of research online first, but they're happy to leverage the knowledge of a travel agent who's willing to interact with them on their terms. When we ask how millennials want to buy life insurance or other financial products, they say they want to work with an advisor. They want help. Regrettably, we know that in the post-DOL world, that's much less likely to happen. While the millennial market offers significant future opportunities, boomers represent now, and they control most of the investable assets in the U.S. They are the other half of the dichotomy. But what's on their minds? What will they be concerned about, and what risks will they be willing to insure? S&P said no other force is likely to shape the future of national economic health as the aging of the world's population. The cost of caring for the elderly will profoundly affect the growth prospects and dominate public finance and policy debates worldwide. Are we really thinking about this as we develop our strategies? Are we creating products and services that will address their needs? Are we really thinking about both ends of the age dichotomy? Executives and companies who ignore demographics do so at their own peril. 37 million boomers have one or more chronic illness. 6 in 10 are managing more than one chronic condition. 1 in 3 will be obese. 25% will have diabetes, and nearly half arthritis. Isn't that joyous? But it's the facts. And according to the WHO, 47 million people are living with dementia today. By 2050, that's 132 million. Healthcare costs for those with dementia in the last 5 years is $250,000. That's 57% higher than any other disease. But it's not just a problem in the US. Globally, LTC and hospice expense represented $183 billion in 2011. That will explode to a mind-numbing $2 trillion by 2030. We are looking at a problem of epic proportions, nothing like we've ever dealt with before. And with people were asked about the scariest disabling disease, 53% identify Alzheimer's and dementia, only 26% identify cancer. So this is what's on people's mind. Yet, policy count and premium for standalone LTC are plummeting. Only 7 million Americans have LTCI, and the number in in-force contracts declined in 2014 and 15. HHS predicts 70% of seniors will need long-term care by 2025. That's 45 million. And we know it's one of the top financial concerns for people when they think about retirement. But you know, there are other reasons this is going to be a bigger issue. Did you know that 30 states have laws that could hold family members responsible for long-term care costs? Now, these rules haven't been actively enforced, but they might be. There was a judgment in Pennsylvania against the son for $93,000 to pay for his parents' long-term care. Excuse me, bill. And while people know they should have it, in fact, few actually buy. Now, we know more carriers have exited the market than entered it. But my question is, can we continue to ignore such a need, such a potential market? We need more and very different innovative solutions, products that have never existed before. Now, some companies are looking at LTC through a different lens. As a result, there's been a significant uptick in combo sales. Companies that saw these increases listened to our research that people wanted combo products. Excuse me. Now, non-retired boomers and retirees hold $26 trillion in investable assets. That's 84% of total U.S. investable assets. Once they're retired, will they be concerned about saving for retirement? Few will be buying life insurance, and they sure won't be buying DI. If we want to connect to this segment of the market, we need to be thinking about new products that address the concerns and the fears that they have. Now, we are seeing some innovation, especially from those that have been long-term leaders in the market. Genworth has just introduced an individually underwritten annuity to cover long-term care. John Hancock has created an LTCI product with a new way of looking at pricing that provides an affordable alternative. But we need far more innovation. In the UK, they're selling annuities strictly to pay for assisted living. In Japan, Taikang is changing its entire business model. They're buying elderly care facilities, they're buying hospitals, and even providing funeral services. They're taking a much broader view, recognizing their demographic realities. As we think about our demographic realities, what are the implications to our business? How prepared are we to deal with an aging population that may not be able to make good economic decisions? It's believed that older Americans are losing $3 billion a year because of financial exploitation. The average victim loses $120,000. This affects us because we may well be in the middle of a transaction that is not in the best interest of the individual. There is a growing debate about what level of responsibility the financial institution has in identifying the abuse. Now, it's very difficult in many cases to know whether a client has a cognitive deficiency or someone's taking advantage of them. It's difficult, too, because 90% of the abuse is perpetrated by family members. Think about it. Your call center rep is trying to be helpful to a family member who's asking for an exception. They may unwittingly be participating in a crime. There is a growing belief that advisors, as well as healthcare workers and bank tellers, must be able to identify those individuals who are suffering from cognitive loss. No one should forget the Neesham case, where prosecutors alleged an agent took advantage of an 83-year-old woman they said showed signs of dementia. Right now, 2 states require producers be educated in elder abuse, and 5 more have legislation pending requiring that your producers be trained. Now, LIMRA's responded by creating, in collaboration with our members, an elder abuse detection training program. It's on our compliance and education platform. Producers and companies will increasingly be held accountable for not identifying and not reporting abuse or perhaps even cognitive loss. Now, this makes some sense because studies do show that money problems can be an early clue to Alzheimer's. As we age, there really is a loss of decision-making cognitive ability, a decrease in short-term memory, and even less capability to do basic math. Now, a Harvard professor has identified 2 types of intelligence. The first is called fluid intelligence. That is the ability to learn and adapt, and crystallized intelligence, knowledge gained through experience. His studies do reveal that fluid intelligence really does decline with age. This really is an explanation for why young people have an easier time learning things like new technology than some others of us. We have recognized that elderly people may not have the same capacity as they did to make good financial decisions. But I believe this makes the case for why annuity is in the best interest of seniors. As people age, many will be less able to make good investment decisions. An annuity provides them with the guaranteed income they want, but also eliminates the need for them to actively manage their assets. Wharton professor Olivia Mitchell, she thinks so too. She's a proponent of payout annuities because it brings peace of mind and takes decision-making out of the hands of those who might be less capable. This is why the DOL rule is so frustrating to me. The demographics are clear. More people need lifetime guaranteed income, and more people are going to be less capable of making good decisions. Yet advice will be difficult to get. I believe the new DOL rules represent a seminal moment in the history of financial services that will have far-reaching implications. It represents the first domino, causing a chain reaction. It will certainly transform distribution and products, but will indeed transform the financial services landscape. I want to touch briefly on a few outcomes. Some will happen because of DOL. Other trends were already in play, but they will be accelerated. M&A activity will intensify. We are seeing M&A already that is distribution-focused. While some carriers view distribution as an opportunity, others see it as a possible liability. But again, this is just the beginning. We see companies like LPL rethinking their future, and others in the BD space will come together to create scale. It just may be too expensive for some to exist. Some companies will look for dance partners to gain scale, broaden access to new markets, and achieve other broader strategic goals. Now, we've seen this for a few years now, but it will intensify. Others will make acquisitions to gain technological capability, whether that's buying a robo-platform or a fintech solution. And you don't have to be a fortune teller to know the cost of doing business will increase materially. Another outcome is consumers will have less choice. Merrill Lynch announced it would stop selling commission-based products in IRAs and migrate to a fee-based structure, but others will follow. But I can't help but wonder, are there other people like me that believe I'd rather pay a commission on a transaction than pay an ongoing fee on my assets? But there will be less choice on many fronts as companies look for a more uniform way to provide advice. Now, the industry argued that people will have less availability of advice. And already, on our early surveys, that looks like it's what will happen. LIMRA surveyed advisors and brokers after the DOL rules were finalized, and both suggested that fewer advisors will serve small investors or service the rollover business. And this, a new study in the UK from its Treasury Department, from the government, has acknowledged an advice gap exists and it's impacting consumers, and this is a result of their RDR regulations. Fact is, most people are willing to pay $100 or less for advice. Most are not willing or unable to pay a fee. But there will be less access to advice for other reasons. The amount of paperwork and the need to comply and the effort needed to do that, some will just retire. For others, their inability to participate in the IRA rollover world will reduce their incomes and perhaps push them into retirement or just leave the business altogether. Even before the DOL rule, sales force growth was not keeping up with the growth in the population. It will likely get worse because recruiting of new financial professionals will be even more challenging. On the positive side, more producers might talk about life insurance and other risk products because, at least for now, it won't have the same restrictions. But demographics don't lie. More people will need help in the coming years, but I'm just not sure they're going to find it. Secretary Perez suggests robo-advice is the answer, but our research shows few people actually know what robo-advice is, and others are just not yet ready to embrace it. In another recent study, people overwhelmingly said they wanted to use both technology and an advisor. But no question, robo-advice will grow and be more prevalent. I believe we're going to see margin compression like we've never seen before. Look at the mutual industry's net flows for 2015 compared to Vanguard's results. Perhaps the market has already voted. We've certainly seen an array of players announcing lower fund fees or changes to their indexed or ETF lineups. There really are many more implications. We just don't have the time to talk about them all. On another front, companies are beginning to truly feel the impact of sustained low interest rates. We're seeing announcements on a daily basis of canceled initiatives and reductions in force. There is no question. Companies will be making decisions looking for ways to reduce cost and improve scale. The next years will be challenging for financial service executives. But we all really need to embrace that the world is different. Disruption is here. While there certainly will be carnage, many of you will view this as an incredible chance and see opportunity. You will see the possibility to build truly new, innovative types of products that really do respond to the aspirations and the fears of both ends of that age dichotomy. You won't just talk about innovation, you'll live it. We need to make lemonade out of lemons. The disruption is here. There is no upside in longing for the good old days. They're just gone. But we are in this together. 100 years ago, LIMRA was created to help the industry overcome the obstacles they faced in another difficult period. Today, we do face unprecedented headwinds. Yet I know we will come through it. The fundamentals haven't changed. The demographics are still in our favor. People need our products, maybe now more than ever. But we must succeed. Millions of consumers rely on our products and our services for their financial security. Thank you.